Hi, welcome back to Financial Accounting 1. We're going to look at putting business transactions into the fundamental accounting equation. So what we have here is Paris. She's opened a new dog walking service, and 1 through 9 are her transactions that she's incurred during the month. We're going to put them up here in our fundamental accounting equation. You can see here we have assets, and they're equal to liabilities plus owner's equity, and that should always stay in balance. So if we do something on one side of the equation, we'll have to do the opposite on the other side of the equation. Let's go ahead and try some and see how it works out. So number 1, Paris invests $25,000 cash into her business. So whenever we're thinking about Paris, we have her personal Paris and we have Paris the business owner. And when we're doing accounting, we're going to take a look at Paris the business owner. So this $25,000 in cash right here, we're talking about cash into her business. So she's going to put it into her business. So we'll come up here under cash number 1. And we'll put in $25,000, and that's going to increase the value of cash for her business. Now in accounting, whenever we do one thing, we're going to have to do another thing. It's a double entry system. So in this instance, she's putting cash into her business because she wants to get something out of her business. She wants to eventually profit from her business. So she's getting a financial interest in this business, hoping that it'll grow. So we're going to go to capital and also increase our financial interest in the business, increasing it by $25,000. Reading number 2, Paris purchases $1,000 in equipment for her business on account. So we have two things going on in this transaction. First, she's purchasing something, and she's purchasing it on account. So first, she's purchasing equipment. So we'll come on up here and we'll find equipment, still under the asset side of our fundamental accounting equation. And she's going to have more equipment since she had a purchase. She may have gone from $0 to $1,000 more. It's going to increase that account. So we'll type in $1,000. And then let's think about it. They didn't say that we're paying cash for this equipment. They said we're going to buy it on account. And on account means that we're going to pay for it later. It's a very special term. So what is the account we use in accounting when we say we're going to pay someone back or owe them the money for later? That's right, accounts payable. So we'll be up here looking at accounts payable. That's the account we use when we want to pay someone back. So we'll go ahead and put $1,000 in there. This will also be an increase because she owes them more, not less. We'll go ahead and put some commas in here so that we can make sure that we're in balance. Here we go. All right, so number 3, Paris pays $300 for supplies for her dog walking operation. So she's going to be getting supplies, $300 worth, and she's going to pay for them right now. So she'll be paying for them in cash. So my cash will be decreasing as she's paying for these supplies, which should be similar to what happens to your own wallet when you purchase supplies. You think of groceries as supplies in your house. Whenever you purchase them, the value of your cash will go down. You can see that this cash and this supply are both under assets. They're on the same side of the equation. So we have a negative and a positive so that our equation is constantly staying in balance. Let's take a look at number 4. Number 4, Paris is doing some work. She receives $50 in cash for performing services. This term, performing services, that is here, you're going to see that quite a bit. When you're going through your book, they're going to perform services. That's going to be a cue to you that they are doing the work of their business. So Paris is a dog walker. Her performing services is walking a dog. So performing services is going to be the business of her business, what she does to make money. That's going to be revenue. Up here, we're going to be looking at revenue. She's going to be increasing the revenue to her business. So let's start there for number 4. We'll put $50 in cash, and that'll be positive. And she received cash for it, so we'll hop back over to the other side of the accounting equation, and she'll be getting her cash increasing, which makes sense. If you're doing work, you want to be paid in cash, you want your cash to increase. You don't want to pay someone else cash in order to do work. That wouldn't be very fun at all. So we come down here to number 5, something that you probably are all very familiar with. Paris pays $50 in utilities. Just like your home, in a business, we have to pay for utilities to keep our business moving and float. So she probably will pay this $50 in cash. So I'm going to come up here to number 5 and put in the negative 50, showing a decrease in her cash, similar to what happens when you pay your utilities. I'm sure you would like all of your cash to go up when you pay your expenses, but you know that's not true. Then we're going to come over here and look at expense. Expenses are cash outflows that are incurred to run your business. So Paris needs to pay her utilities, maybe her electricity to run her computer, or her telephone service to get in touch with the people that she's walking dogs for. So she has this expense, this cash outflow, where cash goes out of her business for things we need to run the dog walking service. So we're going to show this as a positive amount. The $50 in expense is increasing. But I'll bring you up here to notice that we have this negative plus here right before the expense, and that's showing that expenses are a deduction from owner's equity, but we're going to count them up or keep track of them as positives. So we'll go to number 6. Paris performs services on account. So this can also be tricky. Let me italicize this for you right here. Whenever we are paying for something on account, we kind of have to think about it. Is it going to be something that is owed to us or something that we are owing to someone else? So in this instance, Paris is performing a service. She's walking a dog. So it makes sense that some customer would owe money to us. So when we look on account, we kind of have to look at the clues in the sentence and say, well, if we're performing a service, I don't want to owe someone else money. It makes sense for them to be owing money to me. So the account that we use when someone else owes us money is this accounts receivable. We're going to receive it from the customer. It'll be coming into our business. We'll be getting cash in at a later time, but they will pay it to us. It's owed to us. It is a debt to us, so it's on account. So let's put $100 under accounts receivable. And then I told you before, whenever you saw those phrase, perform services, whenever you see that perform services phrase, you want to think about revenue, because that's what we're doing to generate money for our business. So we'll come over here under revenue. We'll add another $100. And we're over halfway through this exercise, and I appreciate you hanging in there with me. We're coming down to number 7. Paris makes a payment of $100 for equipment purchased in number 2. So you can see back here in number 2, she purchased equipment. Now, a little bit later, she's going to make a payment. And I think we're all used to that too. We make a purchase either on our credit card or we get a loan, and eventually we have to pay the piper and make payments and pay back what we owe. So usually you do that in cash. So let's think about that cash first. When we pay money back, when we owe a debt, our cash doesn't go up, our cash goes down. So we're going to show a negative $100 here for cash, show our cash going down. And then we're going to come over to the account where we owe money to someone else. Can you remember what that account is, the account where you owe money to someone else? Did you say accounts payable? If you did, you would be correct. Accounts payable is the account where we owe someone else money. And you can see here's the transaction from number 2 where we recorded a $1,000 increase. Now I'm going to come down here number 7 and I'm going to show a negative $100. I'm going to decrease the amount owed, and that should make sense. If I owe $1,000 and I'm paying $100, I want that balance to go down. I want it to fall. I don't want it to increase. So whenever you're making a payment on account, you want to think about what kind of account it is. In this instance we owe, so it's accounts payable, and we want to decrease it because we're making a payment. Number 8 is kind of the exact opposite of what we've been looking at. Number 8 here, Paris receives $50 from the customer in number 6. So if we look up here in number 6, we had a receivable for walking the dog. A common mistake that many students want to do with number 8 is they want to talk about revenue. But the problem with that is Paris walked those dogs in the past. She walked them back up here where we recorded the accounts receivable. So we don't want to record the revenue because then I would record it twice, once here and once in number 8. So what I'm really recording is the receipt of cash. that customer is giving me $50. So I'm going to come here in cash and I'm going to increase my cash by $50. And that's very important. When someone pays us back, we want to increase our cash. But they don't owe us as much. So we're going to come here to accounts receivable, remembering that accounts receivable is the account where someone owes us money. And they are paying us back $50. So we're going to show a negative $50 under accounts receivable. And that makes sense. Let's just say our friend borrowed $5 from us for parking, and the next day they brought in that $5. They wouldn't owe us anymore. That would be a reduction of what they owed. And that's what we're representing here in number 8. Final one, I'm so proud of you all for hanging with me for this exercise. And the last one we have is number 9. Paris withdraws $100 in cash for her personal expenses. So now again, kind of like similar to what we talked about in number 1. We have Paris the business and we have Paris the person. In this instance, we're kind of trying to split hairs between the person and the business. So she's withdrawing the cash. She's taking the cash away from the business for her personal use. So if she's taking the cash away from the business, subtracting it out of the business, taking it out of the checking account, we're going to have to show a deduction of cash, $100 here in number 9. And then we have a special account we use to show personal expenses. For tax purposes and also for good accounting records, we need to understand when an owner is taking money out of their business. So we have a special account. It's called drawing. Anytime a sole proprietor or a partner would withdraw, we would use this drawing account. So again, we're going to come here and we're going to put a $100. We're going to put it positive because drawing, again, like expense, is a subtraction from owner's equity, showing the owner taking out of their business. In the instance of drawing, it's a cash withdrawal, so it's a cash outflow for the personal use of the owner. And that makes sense. All owners invest in their business so they can eventually withdraw money. This should be a pretty common transaction. So the last thing we're going to do here together is we're going to just kind of add these columns. We'll sum them up. We'll make sure that our accounting equation is in balance. So we would show addition of these 3 numbers, the asset cash, accounts receivable, supplies, prepaid insurance, which we didn't have a transaction, and equipment. So let's add those up. If we add those up, we should get 25,900. So I'll put 25,900 below us right here. We'll add some commas in there to make sure that we are seeing everything the way we should on the screen. And we're going to go to the liabilities and owner's equity section. What we're going to do here is I'm going to go through with you and show you what needs to be added and subtracted. Accounts payable is a liability, so we would add it. And we would also add our capital, which is right here. We would subtract our drawing, the $100, because it is a reduction of owner's equity. We would add revenue because it's an increase in owner's equity. And finally, we would subtract expense because it should decrease our owner's equity as it's a cash outflow. And there we go, 25,009 and 25,009. We are in balance, so we have done this correctly. Sometimes when you do your transactions, you'll find that you're in balance, but you've still made a mistake. So it's not true that it's perfect if you're in balance. But if you're not in balance, you know that you've definitely made a mistake, and you want to go back on through your transactions and make sure that everything is where you want it to be, that you didn't make any transpositions. So thanks for following along the study of the business transactions into the fundamental accounting equation with me. This does follow the exercises in your book, so go ahead and try those and make sure that you turn in those assignments on time. Thank you very much, and I'll see you next time.